Hi, welcome back to this chapter 7 of the Little Book of Valuation. In this chapter, I want to focus on growth companies. You're saying, didn't we do that in chapter 6? There we looked at young growth companies. But let's suppose a growth company has succeeded in growing. It's now much bigger. It still remains a growth company. So let's call this mature growth. Let's look at the challenges in valuing companies in mature growth. So let's start with company characteristics for a growth company that has gotten past the hump, has become a bigger growth company. The first is, even though you might have more financials than you did with the young growth company, the numbers are dynamic. They're changing on a year-to-year basis because the company is changing. The second is, and this is a math issue, which I think we have to bring in, the company is getting bigger even as you look at it. The company that you see 5 years ago is a tiny company relative to the company you do today. You might say, so what? Numbers like growth rates have to be assessed much more carefully as your company scales up. Third is, your company, which might never have used debt as a young growth company, might have started to issue debt, so that has to be something that you bring into your story and into your valuation. And finally, there is a market price history. This company has become publicly traded, but markets tend to overshoot or undershoot with these companies, so it's often short and unstable. So if you're looking at past prices in estimating risk or beta, you got to be careful with mature growth companies. So with that lead in, let's talk about one issue that you might run into, not just with growth companies, but in general, but most, given that many of the mature growth companies we have in the market today are technology companies, it's an accounting issue. Accountants have a problem with intangible assets. Step back. Now, when you look at accounting, the way accounting looks at expenses, it classifies expenses into three groups. You got operating expenses that are expenses designed to create benefits in the current year, capital expenses that create benefits over many years, and financial expenses are expenses like interest expenses on debt. Now, capital expenses in particular, accountants are not always consistent. And here's what I mean by not always consistent. If you're a manufacturing company and you build a factory, accountants treat that as a capital expense. But if you're a technology company and invest money in R&D, they treat it as an operating expense. We talked about this a little earlier when we talked about accounting. But this is a particular issue with mature growth companies that are non-manufacturing, is the expensing might get in the way of actually you assessing how much the company's actually made as profits and how valuable it is as a company. So almost as a first step, you got to clean up for the accounting before you start the process of valuing these companies. And we'll talk about the specifics about how to do that, but you can see the need for it is going to be greater for growth companies. Now, in terms of general valuation issues you run with mature growth companies, I think the biggest issue is the scaling issue. I've said that word before, but let me back up and explain what I mean by this. Much of what you see as historical growth or returns in your company reflects the history of this company. But 5 years ago, let's say this company was $1 billion company in terms of revenues, and today it has $20 billion in revenues. Growing at 40% a year when you have $1 billion in revenues is much easier than growing at 40% a year when you have 20 billion in revenues. So one of the things that almost inherently has to be considered when you think about expected future growth rates is, how big is my company today relative to where it was 5 or 10 years ago? In general, growth rates will scale down as you scale up as a company. It's almost mathematical. You can't fight it. But great companies are able to keep the scaling down to a lower level. In other words, they scale down slower. It's not that they don't scale down, but they scale down slower. So when you value a mature growth company, as part of your story, you got to tell me what you think about this company's capacity to maintain its growth rate, at least not let it drop too much as it scales up. Now, the company I'm going to use as an illustration for this chapter is Alphabet. I'm going to call it Google because, given that it used to be called Google until it renamed itself, it's still the name that I attached to the company. So as I said, the first step is going to be to clean up for the accounting. But before we look at Google and cleaning up for the accounting, let's talk about the pricing issues you run into with mature growth companies. Now remember, unlike young growth companies, mature growth companies have substance. Substance in what sense? They're Their revenues are no longer small or negligible. They're much bigger. There are some of them are making money, and some of them could be making a lot of money. But you still run into issues in what should I use as comparable firms? You think, why not other tech companies? What if your company is the only mature tech company in a sector full of young tech companies? That's going to make it difficult to find a peer group. What should you use as a base year number? And you're going to have more choices here. Should I base it on revenue? Should I base it on earnings? Should I base it on book value? How do you control for differences in growth? You could have 10 mature growth companies, but one's growing at 9%, the other's growing at 6%. How do you control for growth differences? And how do you control for risk differences? Risk can also vary across a peer group, even if you have a bunch of mature growth companies in your peer group. So let's start with cleaning up after the accounting. I've given you my rationale for why R&D and R&D-like expenses should be capitalized. And let's say you decide you want to capitalize R&D expenses at Google/Alphabet. The first step in capitalizing R&D expenses is coming up with an answer to a question that at first sight you're going to say, I can't answer that question. So here's my question. On average, how long does it take for a company like Alphabet to convert R&D into a commercial product? It's called an amortizable life for the assets. I'll give you in a generic sense a way to think about answering that question. If you take a typical pharmaceutical company in the US and you do R&D, it can take 5, 10, 15 years for that R&D to pay off. If you're a software company like Google, it's probably much quicker. Let's say it's 3 years. Once you come up with that life, you go collect the R&D expenses from the last 3 years, the last 5 years, the last 10 years, depending on the amortizable life. And here's what you do to capitalize R&D. So in the case of Google, I used a 3-year life. I started with the most recent year's R&D expense, and I looked at the last 3 years. Now remember, if R&D is a 3-year life, here's what you'd be doing if you'd capitalize R&D right from the beginning. Rather than showing the R&D expense each year as an expense, you'd be writing off 1/3 each year. So the R&D from 3 years ago, the 27.57 billion, I'm writing off 9.2 billion this year. There's nothing left. I've written it off over 3 years. R&D from 2 years ago, 31.6 billion, I'm writing off 1/3. There's 1/3 left over. R&D from 1 year ago, I'm writing off 1/3. It's 2/3 left over. You're saying, what about the most recent year? The most recent year in terms of timing is actually just completed. So it's almost like I spent the 42.6 billion yesterday. I haven't had a chance to amortize it yet. The entire amount is unamortized. I'm going to keep track of both how much I'm amortizing this year, 32.9 billion, as well as the unamortized portion. And here's why. The unamortized portion is now going to show up on my balance sheet, both as an asset and to augment my book value of equity. So my book value of equity for Google, which is going to be the 256.1 billion the accountants told me it was, plus I'm going to add the 79.45 billion in unamortized R&D capital. So I'm going to do that to both my book equity and invested capital. That's going to increase both my book value of equity and my invested capital. You say, what do I do with the amortization? My stated operating income at Google was 74.8 billion. But remember, that was after subtracting out R&D expense as an operating expense. So I'm going to say, look, I should not have subtracted it out. So I add back the R&D expense from the most recent year. But I subtract out my amortization of R&D. I'm replacing the R&D expense with the amortization of R&D from previous years. In effect, I'm going to raise my operating income and my net income by about 10 billion. So here's how it's going to play out. When I look at things like net margin, operating margin, return equity, pre-tax return capital, those accounting measures of profitability, I'm going to get different numbers when I adjust for R&D. In fact, with Google, when I look at margins, my margins become higher when I capitalize R&D. My net margin goes from 21.2% to 25%. My operating margin also jumps from 26.5% to 30%. My return on capital and return equity decrease. Why? Because even though my income is higher, I end up with a lower return because I've capitalized the R&D. My denominator grows by more than my numerator. Now do you see why we need to capitalize R&D? To get a better sense of how profitable your company is, what kind of returns it's earning on its investments. You need to capitalize R&D to get a better sense of that. So with that lead in, let's talk about valuing the operating assets for a mature growth company. When you think about revenue growth, often you look at past revenue growth. There's nothing wrong with that, but remember, past revenue growth for a mature growth company might overstate future revenue growth because the company's become larger. In the case of, as with any company, when you forecast out the revenue growth for the future, you have to think about how big the total market is. If your total market is mature and your mature growth company already has a big market share of that market, your growth has to come down, because to grow your revenues now, you have to take market share away from other companies. You also have to look at the strength of the competition, as well as the quality of the products and services your company offers. Kind of abstraction. So let's think about Google/Alphabet. Google's big business is online advertising. In fact, it is a dominant online advertising company. It already has a dominant market share. It shares that market with one other large company, Facebook, and a bunch of wannabes, tiny market shares. So the good news for Google, it is a large market share of a large market, in this case, online advertising. The challenge for Google is that online advertising market is now growing slower than it used to, because much of the easy growth is done, where you stole revenues or you moved revenues from traditional advertisers, newspapers, billboards, into online advertising. So looking forward, I think Google's revenues are going to continue to grow, but at a much lower rate. In fact, I'm going to give them a growth rate in the single digits, a high single digits, because I think there's still remaining growth, not just in online advertising, but in some of the other businesses that Google's in, especially YouTube. I'm going to give them an 8% revenue growth. But this is a factor to look at when you look at mature growth companies, is they can have a history of double-digit growth, but looking forward, if the market's starting to mature and your company already has a market share, you've got to get more conservative in your forecast. After the next 5 years, I think the growth rate is going to start to scale down towards a stable growth rate. In terms of profits with mature growth companies, you start off with an advantage relative to young growth companies. They have already shown the capacity to make money. And right now, if you look at a company like Google or Alphabet, it's, Google/Alphabet, their margins already reflect the fact that they're immensely profitable. Their current operating margin is about 30%. Remember, the economies of scale have already played out. So you can't call on some of the things you call on to push up margins. Basically, improving margins here is going to come from cutting costs. And let's face it, one of the things we've learned over the last 2 or 3 years is tech companies have a lot of fat that they can cut. And I think that cost cutting that started about 2 years ago is going to continue. And that's going to improve margins, not dramatically, but to about 32% by year 5. And it's going to stay at about 32%. So this is a relatively modest story, 8% revenue growth, slight improvement in margins. Now, as with any other company, I have to think about reinvestment. And here I think I'm going to, there are 3 ways you can estimate reinvestment. One is you can use that sales to capital ratio, which we used with startups and with young growth companies to estimate reinvestment. That option remains available. The second is if you assume the margins have reached steady state, they're stable and returns on capital are also predictable and stable, you can estimate the growth as the product of your reinvestment rate and your return on capital. If you remember our earlier discussion of growth, this is sustainable growth. And the third is, if you've already as a growth company invested in capacity, you have a lot of excess capacity, you might get some free growth. Free growth in what sense? Be able to grow at least for the near term with relatively little reinvestment. In the case of Google, I'm going to use the sales to capital ratio, and I'm going to use the global industry average for online advertisers. It's about $3.09 of revenues for every dollar of capital to estimate the reinvestment. Remember, because my growth is much more modest in this valuation, the reinvestment assumption becomes less critical than it was when I valued young growth companies or startups. So I'm ready to estimate my expected free cash flow of the firm at Alphabet. So if you notice, my revenue growth is 8% for the next 5 years and drops off to 4% in steady state. That's my stable growth. Of course, everything is being done in dollar terms. So my revenues increased from 282 billion to 567 billion. So before you accuse me of being too conservative, I am doubling revenues over the next 10 years to make Google one of the larger companies in the world in terms of revenues. My operating margins right now is very close to 30%, improves over time to 32%. Again, from that cost cutting that they've already started on. Higher revenues, slightly improved margins. My operating income reflects those assumptions, goes from 85 billion to almost 181 billion. Now, if you notice, my tax rate changes over time, and here's why. Right now, Google's effective tax rate is about 15.9%. Why? Because it is able to defer taxes, it has good tax lawyers. I'm going to assume that that's not going to dissipate immediately. In fact, I'm going to allow them to stay at the effective tax rate for the next 5 years. But beyond year 5, I'm going to push that tax rate up towards a marginal tax rate for all US companies. Why? Because you can't defer taxes forever. Eventually, it catches up with you. So that tax rate gives me my after-tax operating income. For the reinvestment, as I said, all I'm doing is taking the change in revenues from year to year. In this case, from 282.8 billion to 305 billion, and dividing by the 3.09, the sales to capital ratio, and I get my reinvestment each year. Not a huge factor for the next 10 years. You're saying, why does my reinvestment jump after year 10? Because I assume after year 10 that the return on capital can't stay at the sky-high levels that they have right now. It's going to get to be more of a grind, and I estimate my reinvestment based on that sustainable growth equation that we talked about by using the growth rate and return on capital. So I've got my expected free cash for the firm for the next 10 years, and in steady state, this adjusted free cash flow that I can sustain in perpetuity. Now, when you think about risk again with mature growth companies, you're past the biggest danger. Young growth companies, you could fail, your cost of capital is high because you're money losing. Mature growth companies are often money making, but they might still have some remaining risk. In the case of Google, I actually estimate the cost of equity based on the business they're in, online advertising. The equity risk premium, the parts of the world they're operating, much riskier parts of the world, a higher equity risk premium. I do estimate a cost of debt based on the low default risk I see in Google, 0.8% default spread. But the overall cost of capital reflects the fact that this is a company that's almost entirely equity funded, 11.3%. Over time, I expect that cost of capital to drift down, partly because I think Google will come under pressure and eventually succumb to borrowing money because it will lower the cost of capital. And the cost of capital move towards the average cost of capital for all firms. The time that I did this valuation was about 9%. Now, of course, to get valuation closure, I've got to make assumptions about what will happen once I get to year 10. Now, you might push back and say, why just 10 years of growth? Because, with 10 years of growth, I've already made Google into one of the largest companies in the world in terms of revenues, 567 billion. I think those are large enough revenues that I should be able to put the company into stable growth. But remember, when you put your company into stable growth, two things to factor in. One is the cost of capital has to reflect the cost of capital of a mature company. That's why I moved it to 9%. And second, if you have growth in perpetuity, you got to make sure you have enough reinvestment. And that reinvestment, rather than use the sales to capital ratio, you have to estimate using a growth rate in perpetuity and a return on capital your company can make. So in the case of Google, I will assume that by the time you get to year 10, the return on capital will be lower than it is today. 15%, that's actually a pretty high return on capital in steady state. I'm assuming continued competitive advantages, higher than my cost of capital, which is only 9% in steady state. But that 15% return on capital with a 4% reinvestment rate will require a reinvestment of almost 27%. That's why you saw my reinvestment jump in my terminal year. You subtract the reinvestment from my after-tax operating income. My terminal year is year 11 because I'm doing my terminal value in year 10. I get a terminal value of almost $2 trillion. I'm almost there. I bring that $2 trillion into year 10. I discount my cash flows back to today, including my terminal value at the cost of capital. And remember again, because the cost of capital is changing, I have to use that cumulated cost of capital. I get a value for the entire business today of about 1.3 billion. I'm almost home because to get from the value of the operating assets to the value of equity per share, I've got to tie up all the loose ends. In the case of Alphabet, those loose ends included 113.8 billion in cash that they had, about 30.5 billion in other non-operating assets holdings in other companies, their venture capital holdings, subtracting out 14.7 billion in debt that they owe. Then you divide by the number of shares. And I include restricted stock units in the share count. Google and Alphabet did not have any options anymore because they'd switched from options to restricted stock about a decade ago. So no options to clean up for. But the value per share that I get with my story and my estimates for growth and margins and reinvestment is about $113 per share. Now, in terms of pricing growth companies, again, remember, we're looking at Alphabet in 2023 trading at a PE ratio of about 28. Okay? Now, it's about, and that PE ratio is actually almost the median for the sector. So if I just stop there, I would say Alphabet looks fairly priced. But analysts are projecting earnings growth for Alphabet of 17.3%, higher which is much higher than the median. So you can maybe argue that even though it's trading at the same PE as the sector, because its growth is higher, it's mildly underpriced. That's storytelling. Now, that's the first way you can do pricing is just compare your company's PE to the sector. The second is, and we talked about this in an earlier chapter, you can adjust the multiple for what you think is your key concern. In this case, differences in growth, you can compute a PEG ratio. If I take the PEG ratio for Alphabet by dividing the PE by the growth rate, I end up with a lower PEG ratio than some other companies, but actually pretty close to the median for the industry, again suggesting a fair pricing. And finally, I could look at the relationship between PE and growth within this sector. When I run that regression, I see that every 1% increase in growth increases my PE by about 0.85. The R squared is 19.3%. Not bad, but not great. I get a predicted PE for Alphabet using a regression of almost 39.5. With the regression, it actually looks like Alphabet is underpriced. Now, which one should you hang your hat on? I'm not a great believer in pricing to begin with, but I think if you look at the pricing of mature growth companies, at least you have a basis for making the judgment. I hope you found this session useful, and thank you very much for listening.